Hi everyone, Joe Gentili from the law firm of Saraf Gentili LLP. For those of you that are unfamiliar with us, we're a law firm based in New York. We focus a lot of our energy representing policyholders in life insurance disputes. And the topic for today has to do with IUL and why the engineered proprietary indexes and IULs frequently underperform policyholder expectations. So for those of you that don't know what I'm referring to, if you purchased an IUL in recent years, you'll notice that there's several index options that you could allocate your money to, your premium and cash value to. And there's the S&P 500. That's not what we're talking about today. What we're talking about today are those other account options that are engineered indexes, meaning that they're indexes that don't exist in real life and they exist just as a crediting option for the life insurance policy. And usually they come with the brand name of a large financial institution or a bank attached to it, which really helps them with their marketing purposes. These engineered indexes exist and they appeal to insurance companies because A, they're great marketing tools for them. They're a great tool to take the brand name of maybe a more well-known financial institution or bank and stick it on their product. It also allows them to make the budget for the insurance company in terms of offering these indexes. It makes it more predictable and usually cheaper than offering the S&P 500. So they really like to steer people towards these. And probably most importantly, they illustrate really well. There's some what I consider to be loopholes in how they illustrate these products that make them look a lot better than they are. So that's why they appeal to the insurance companies and why they exist. The problem is for policyholders, a lot of people buy these IULs to begin with because these engineered indexes illustrate so well. They look like they're have a long history of producing fantastic returns, which isn't really accurate. And the reason for that, or there's a number of reasons for that. So first, I would say that it's very important to understand that there's when they're showing you results of how this index performed over the last 20, 30 years, or however long they're showing that it performed, it's important to understand that the index has not actually existed for that long. Those backcasted results, those past results, by and large, the vast majority of it are hypothetical. The index was created knowing these historical results or these historical market conditions. So the index was created a lot of times, I think, just for the purpose of looking good in this backcasted thing. Now, the problem is that it's easy to have an investment that looks good when you know what the past looks like. However, conditions change, and these indexes are built more with the idea of looking good on paper and how they would have performed in the past and how they will actually perform in the future. So it's you need to look at this with a large grain of salt when they're showing you historical performances, and I put that in air quotes, historical performances for these indexes. The other thing to understand is that these indexes today are almost all volatility controlled indexes. They're almost all what's called excess return indexes, and they are built to basically have low returns. They are built in such a way that the volatility is low, that if the index is doing really well and it's going up, the index has the formula, for instance, will move some of the allocation to cash to kind of slow down the increase in value of the index, or they'll deduct current interest rates from your returns on the index. And the reason why this is done is because that helps keeps the options cheaper for the life insurance company. So the life insurance company, again, these aren't real indexes, they don't exist. It's basically a crediting tool that the life insurance company has. and they have to buy financial instruments to offer this. And the lower the volatility that there is, the cheaper these financial instruments are for the life insurance company. It's also important to remember that most of the moving parts that have to do with these engineered indexes are within the discretion of the life insurance company. So for instance, if you're getting an illustration and there's really high participation rates in it, meaning that if the index, you can get 150% return of what the index is, the life insurance company typically retains the discretion to cut that later. They also can cut the caps. So if right now you're capped at 10% or there is no cap, they could change that. They can cut the index altogether. If they don't want to offer the index going forward, typically they don't have to. So there's a lot of moving goalposts with these, which makes them very hard to predict how well they're going to do over a long period of time because there's just so much discretion that the carrier maintains. Another thing to remember that, and this impacts returns a lot, like I mentioned earlier, life insurance companies offer these indexes using an options budget. And that options budget is funded by the returns on the life insurance company's general account. Their general account is mostly invested in bonds, government bonds, corporate bonds. These are very interest rate sensitive investments for the life insurance company. So if you go through periods of time with low interest rates, they will have a lower options budget to purchase options to offer the indexes. And so if you end up in these periods of time where you have lower interest rates and higher volatility, they have less money to buy. They have less money to fund the indexes with. The indexes also at the same time become more expensive to fund. Not a good formula for getting good returns on your crediting rates. So I would just keep in mind a few things. Number one, don't rely on the illustrations. They are unfortunately frequently used by agents as projections. They're not meant to be projections. They are simply there to show how the life insurance policy works, but they're not used that way most times. So keep in mind that the illustrations, don't rely on them. If you're looking at an engineered index and it's got this long history showing, fantastic performance, it makes sense to ask the agent, okay, that's the hypothetical. If the index has been live for a couple of years, ask to see what the results are for the years that it's been live and it's actually in the marketplace. I think not always, but a lot of the times the actual performance is going to be very underwhelming for people. It may change your expectations with the policies. The last point I'd say is you have to understand the insurer discretion part of this. This is not a normal investment. I know it's life insurance. It's not supposed to be an investment, but it's not a normal investment or a normal bet on the return of something because the party that you're essentially betting with, the life insurance company, they could change the rules later on. They could lower the participation rates. They could lower the cap rates. They could remove the index that you're invested in, change it to another index. So there's a lot of discretion. They could also change the cost of insurance in the policy sometimes to just make the ownership of a policy more expensive. So keep this all in mind. The consequences for having a life insurance policy that's underperforming. So let's say you're funding your life insurance policy as if you're going to get the forecasted 6% returns on the IUL and the index. Let's say you're funding it, but in reality, it's returning much less than that. That's creating the conditions to have either a lapse or the need to add a lot more money into a policy than you assumed if that underperformance continues for a long period of time. So it's a type of thing where it's not uncommon where decades down the line, if you have a policy that's underfunded or underperformed, that people end up lapsing the policy and end up with zero. They don't, they never get a death benefit, or their family never gets a death benefit. They never get to use any cash value in retirement because it doesn't last that long. So the consequences can be pretty severe. If you have not bought one of these policies yet and you're looking at it, I really would advise extreme caution. If you've already bought one of these policies and you're seeing these underperformances, or you're seeing things that you were told that just aren't true, I strongly suggest that you reach out to an attorney. You could certainly reach out to us. It's worth it to take a look and see if you have any legal claims, the ability to get some money back, tied to the purchase. So, as always, if you have any questions, please feel free to reach out. And I hope you enjoyed this, and please subscribe. We're going to be making more videos on this content, on this subject in the future. Thanks. Bye.